If you invest in Tesla stocks or are intending to invest, then this video is for you. Tesla stock has continued to show real progress, but yet again was under controversy. And on the news, has it received a new Wall Street high target price from an analyst who made a bold assumption that Tesla's competition can't stop Tesla's hypergrowth for the next 5 years. And in this video, we will break down important facts about Tesla stock that will help inform your decision making. Tesla shares traded higher after receiving an upgrade from analysts at New Street Research, who also lifted their one-year target price on the electric vehicle maker to a Wall Street high of $578 per share. Tesla bull Pierre Ferragu of New Street Research has been a longtime supporter of Elon Musk's electric car company. A recent note from Ferragu, along with a newly adjusted price target of $578 from $400, indicate the analyst sees a decade of hypergrowth ahead. It is well noting that Ferragu also upgraded his rating on Tesla stock from neutral to buy. Another interesting note about Ferragu's newly adjusted price target is the analyst's belief that Tesla has no genuine or credible competition on the horizon. This has been challenged by automakers like Lucid, who claim to match Tesla's claim to performance. But Lucid has yet to begin production on an automobile, and even Nikolai, that was almost a rival, seems to be in trouble, even before production of any of their vehicles started. Meanwhile, Tesla is coming off its most successful quarter in company history, with the recent release of its Q3 delivery and production numbers. It delivered 139,300 cars during the third quarter, beating Wall Street estimates of 136,000. More than 124,000 of those vehicle deliveries consisted of the Model 3 and Model Y. The better-than-expected third-quarter figures offset what was widely panned as a non-event Battery Day reveal, in which Tesla failed to impress or deliver a newer, cheaper, longer-range battery. Tesla CEO Elon Musk did lay out plans to produce a lower-cost battery, build a $25,000 electric car, and eventually produce 20 million vehicles a year. Though not until 2023. A revelation that sent the car and battery maker stock price tumbling for a while before picking up. Despite the already insane performance of Tesla stock recently, analyst Pierre Ferragu thinks that there's still more to come, with more catalysts. Tesla's forced march toward electrification is reaching a tipping point. Cost parity is around the corner. Barriers to adoption are pushed away. Drivers are enthusiastic, and the industry is betting all in on electric. The rest of the industry is indeed starting to bet heavily on electric vehicles, and several analysts are expecting those bets in the form of competitions to impact Tesla's growth in a negative way. Well, not Ferragu, who says that Tesla has a decade of hypergrowth ahead and has no credible competition on the horizon. Ferragu states that Tesla has an addressable market in excess of 20 million units already. The Model 3 is the company's biggest seller and has been a main driver in its intrusion into other markets. Model 3 has clearly demonstrated drivers trade up to the Tesla brand, with 2/3 of buyers trading in non-premium cars, which represents an additional 12 million addressable market, Ferragu writes. Tesla also addresses the entire premium segment, with high-end and mid-end sedan and SUV models. This is globally an 8 million unit market, and in addition, the Cybertruck addresses a 3 million unit global market. Tesla has continued to show growth in a sector with little to no real players, as far as other manufacturers are concerned. While the EV segment is still relatively small, accounting for between only 1 and 5% in various countries worldwide, Tesla has managed to grow the presence of electric cars on the road single-handedly. Musk solved the problem of charging vehicles by building charging facilities nationwide in the US. And thanks to dramatic increases in battery technology and price decreases, Tesla has emerged as the most dominant force in various automotive markets, regardless of powertrain. While the Model 3 has become the company's highest-selling vehicle, due to various affordable price points and efficient range ratings, the Model Y is beginning to broaden its reach. According to the EV sales blog, despite being released only since March 2020, the Model Y is at top 20 EV globally. Also, competition is slowly and steadily falling behind due to their lagging in the EV sector. While working toward the goal of eventual electrification, many companies are still at least 5 years away from catching to Tesla level. Tesla by far is the only EV that offers higher range for cheaper prices compared to other automobile powerhouse. EV pure plays are flourishing and doing better, but won't have any competitive advantage to beat Tesla, Farragut writes. At best, they will follow suit, the leading brand in its success, with less scale and less experience. For example, less experience has contributed to Volkswagen's bottlenecks with the ID.3 software, which has been the main point of concern for the German automaker, and issues have plagued the ID.3 software since its first production units. Some Tesla bears often cite that the company's shares have been trading at 50 to 100 times multiple. But Farragut pointed out that Amazon stock has been trading at that multiple for over 10 years. And he sees Tesla shares continuing to trade at a 5 to 100 times multiple for a decade. New Street Research is not the only financial firm that upgraded Tesla. Bearish investor JP Morgan Chase boosted its price target of Tesla and increased its price target from $65 to $75. That alone should speak volume. In related news, Tesla CEO Elon Musk tweeted that the company's Berlin-based Gigafactory will build Model Y electric vehicles featuring the new battery design, but this will be at a significant production risk. Berlin will use 4680 cell with structural battery pack in front and rear single-piece casting. Also a new paint system, wrote Musk in the tweets. A lot of new technology will happen in Berlin, which means significant production risk. Fremont and Shanghai will transition in 2 years when new tech is proven. So in a way, Farragut might be right. As competition are catching up, Tesla might move ahead of them, especially if the new battery technology works out and is set for production. That alone could boost Tesla's shares and even give a 5-year gap on their competition. There is really no credible competition on the horizon. See, it costs traditional OEMs $18,000 to electrify a car, which results in lost profits, and electric models selling at an average of $16,000 premium to ICE equivalents. OEM, also known as original equipment manufacturer, are the original producer of a vehicle's components, as the automotive components are the official genuine parts produced directly by your vehicle's maker. So by contrast, Tesla cars sell for less than their equivalent premium ICE competition. Traditional OEMs, therefore, cannot compete as long as they do not get to cost parity, and they are still at least 5 years away. EV pure plays are flourishing and doing better, but won't have any competitive advantage to beat Tesla. At best, they will follow suit, the leading brand in its success, with less scale and less experience. As most investors know already, only the ramp of production capacity limits Tesla's growth in at least the next 5 years. And as a result, we expect virtually no pressure on prices, leading to expanding margins. This means Tesla, as it stands today, will become the largest and most profitable premium car manufacturer in 2026, if everything goes well before 2025 with battery technology and gigafactories. Tesla's addressable market might have quadrupled in volume with lower-priced cars. The energy storage opportunity will have matured, representing a $750 billion addressable market. This means Tesla will be even larger and still be in hyper-growth mode. And we haven't even talked about AutoBidder, which is also a part of Tesla's energy future, a technology that is already in use at Hornsdale Power Reserve in Australia for several years, where it has reduced system costs and exerted downward pressure on prices. Hornsdale flexibility saved an estimated 14 million Australian dollars, which is $10 million across Australia's various markets during a single islanding event in 2019, and went on to save customers more than 50 million Australian dollars, which is about $34 million over its first year of operation, an impressive feat. Another thing to factor in is strong Chinese demand. While the recent rally was shot down by a strong sense of euphoria and a risk on sentiment that swept across tech stocks, there are several fundamental catalysts coming down that could drive the next move up. Demand out of China has been surprisingly strong, with Wedbush forecasting income Q3 deliveries to be around the 140,000 mark versus the 136,000 consensus. In a note to investors late last month, September, they said the clear standout this quarter yet again is the massive underlying demand coming out of China. We have seen demand surge in China for Model 3s in this key region, with Giga 3 firing on all cylinders heading into the year-end. Analyst Dan Ives is expecting to see some solid numbers in the company's upcoming earnings report, as well as strong forward guidance. Based on this recent uptick in demand, delivery estimates for the year should be coming in around the 500,000 mark. considering how bleak the outlook was in Q1 when factories were shutting down due to COVID. This would be a remarkable turnaround for Tesla. Musk and Tesla are doing everything they can to drive demand from their side. For starters, in the past week, they've cut their Model 3 prices in China by about 10%. This move was designed to add some fuel to the fire for demand as China continues to recover from the coronavirus pandemic. In the medium term, Tesla hoped to reduce prices globally, so has to open the company up to a wider market. These can only be good things as the company continues to strengthen its footprint in the electric vehicle space and become the benchmark that all others are judged against. Tesla will host its quarterly earnings call for Q3 2020 on Wednesday, October 21st. With that, analysts at numerous firms across the country are preparing and revising their estimations for the electric automakers' quarterly call. With so much buzz, we can only wait and see how it plays out. And that's all we have for you today. Thank you for watching. Till next time.